Hello guys, welcome back to Study FX channel. On this channel, it's all about forex trading, binary trading, and crypto trading. So if you're new here, welcome. If you're a returning subscriber, thank you for always coming back to watch my videos. So guys, on today's video, I'm going to be teaching you 5 indicators that I commonly use to trade a rise market. So make sure guys you watch the video until the end. So to celebrate 400 subscribers, I'm going to give away three ebooks to 5 of my subscribers. So all you need to do here is to comment, subscribe if you haven't, like this video, and I'm going to choose the winners randomly, and then you have to the telegram, text me there and I'll send you to your email or in your telegram. Let's get started. The candlesticks that I'm going to teach you today is called a hammer. So this candlestick has a small body with a long lower shadow and little to no upper shadow. It resembles a hammer shape. So it typically appears after a downtrend and signals a possible reversal or a bullish trade. So this candlestick can be in either color. It can be in red or in green, or it can either be bearish or bullish. So the long lower shadow suggests that sellers pushed the price lower, but buyers stepped in to push it back up. This indicates potential buying pressure, hinting that the downtrend may be losing momentum. So guys, we are going to head directly to the trading view so that we can check this candlestick and to see how it was respected in the market. So also make sure you use this candlestick, although also the others you need to use these candlesticks in conjunction with either support, resistance, there is order block, demand and supply. I'm going to be teaching you later in my videos. So let's see. So here guys, we are in volatility 50 index. So we are going to check randomly to find a candle, a hammer candle, and we have to make sure it's either on support or from a downtrend. So I have one here. So as you can see here, this area, it was previously respected. As you can see here, it was rejected first time, second time. That time, this is our hammer, our first hammer, but I want you to concentrate on this one. So as you can see, this one, it did come here. The buyers pushed the price higher. Then the second candle, it ended as a bullish. Also the third one, they did create a hammer, and then the price continued to go up. So that's why I'm telling you guys, you have to use it in conjunction with other indicators or with other things like support and resistance, demand and supply, etc., etc. So let's check another example to see if you're going to find another hammer in the market, and so that you can learn how it's being respected. Also, another thing, don't use the candlestick if it's in between a downtrend or a uptrend without confirming. And also confirmation, it's always waiting for the next candle to form. Like for this one, you can see this one, it's on an upper trend. So let's see the first candlestick here. So let's say you saw a hammer here, this hammer that's I'm pointing. So let me come here. So let's say you saw a hammer here and then you decided to enter the market. You can see the second candle did create a a bearish candle, meaning you have to wait for a market to create at least a confirmation. And it did come here, created another hammer, and then created a bullish candle. So if you entered with that candle, you could see you could have made a profit. So for this one, I'm just explaining for scalping that we use maybe one, like you just have to rely on this candlestick, maybe enter a board, or you can do manually, or also you can input. You have to wait for 2 minutes, 1 minute, and then you exit the market. So as you can see, this one, it's happening on an uptrend, but if it's happening on a downtrend and you don't know if the market is going to go up, because sometimes you can't really tell when it's on a downtrend if it's going to reverse. That's why I have emphasized on drawing your support and resistance so that you can know when it reaches that point. You can see this one, it's another hammer. You can see it created a confirmation like the one I have told you, like you have to enter the market after a confirmation. So let's say you entered with this one. So if you did enter at the start of this candlestick, you could have seen, if you waited for 1 minute, you could have won, and if you did input 2 minutes, you could have won the same. So for hammer, always wait for a confirmation over candlestick. So it's just that simple. So let's get to our second candlestick that we are learning and that we are going to use in our trading rise market. So the second candle that we are going to learn today, it's the morning star. This morning star is a three candle formation candlesticks. So the first candle, it's a large bearish candle showing it's from a downward momentum. The second one is a small bodied candle. It can be bearish or bullish, and also it often shows indecision, but not always in the market. But it's small bodied, like it's not a long one. The third candle, it's a large bullish candle that closes well into the first candle's body. Like it have to be more than half of the first candle. So this pattern typically appears at the end of a down trade and signals a potential reverse to the upside trade. So it usually represents a pause in downward momentum, showing that buyers are regaining their control. So let's go back to our chart and check out our morning star. So I'm going to change the volatility here to 100. So here we are, guys. I'll just use the first that I have seen here. So as you can see here, the first candle is a bearish candle. The second one, it's a small bodied candle, and the third candlesticks, it's a bullish candle. As you can see, if it's forming it at our support, you can see first rejection. Let me move it here. So there is first rejection, there is the second one, and this one, it's the third one. So if it did form at our third point and we saw this morning star, you can enter the market. So let's say we did enter here, you could say if you did input 1 minute or 2 minutes, you could have gotten out the market with a profit. So it's just that easy. So let's go to our third candlestick that you need to learn. So the third candlestick that you are going to learn today, it's three white soldiers. So these patterns consist of three consecutive bullish candle, each with a higher close than the previous one. I think if you identify this candlestick in a market, it's so good to trade rise market. Like even if you're using a bot or manually, you exit with so much profit because at least you're sure the bullish is taking control of the market. So each candle closes within the previous candle's body and closes near its high with little to no shadow. Like the wicks are a bit small. It usually appears after a downtrend and after or a period of consolidation. So it's either downtrend or there is a consolidation. It signals a strong shift in market sentiments towards buying. So let's go to the market. Let's go to the trading view and check out the white soldiers. So here we are, guys. So I'm just going to use this volatility. So let me draw another. So let me just move this one here. So as you can see here, there are so many multiple rejections. The first one, the second one, the third one, fourth, and the fifth. So I'm going to use this example. So you can see after it touched the support, you can see it formed the first bullish candle. As you can see, this one, it's a marubozu, meaning it has no wicks. And the second one did open and close above. The third one did the same and closed above. So if we did open on our third candlestick, you can see you could have made profit. And you can see here it did push the market up more further. Even here, you can see there's so many examples that you can use here for for the white soldiers, but make sure you follow this trade after a down trade or a consolidation. So another we have here, although here the market was consolidating, so let me just bring it here. But because we're just scalping as traders, like we are using maybe 1 tick, 1 minute, you can choose to trade the market. So this one, it's another support, this one, it's another resistance, but we are going for buys. You can see here it did create the first one, the second one, and the third one. If you did enter here, you could have made profit. Also, it did come here down, so you could have waited for this one, the fourth candle, the fifth, the sixth, and then up. But it's usually recommended after a down trade. So you can see this one here for morning star, it's followed by another candlesticks. So meaning this candle usually appears more frequently Our fourth candlesticks that we are learning today, it's a bullish engulfing pattern. So this pattern occurs when a small bodied candle is followed by a large bullish candle. So the first one has to be bearish and the second one has to be bullish. So the second candle has to engulf the previous candle's body, meaning it's showing a strong reversal to the upside, indicating that buyers have taken control. So let's go back to our chart and check out bullish engulfing candlestick. So here we are again here in our chart. So let me just use this example. So we are here at our support here. You can see the market came down here, tested our support and then did form a bullish engulfing. You can see the first one, it's a bearish, the second one engulfs the first candle. And after it engulfs, it did go up. Our fifth candlesticks that we have here, it's a piercing line. A piercing line, it's a two candle formation that appears during a downtrend. The first candle, it's a large bearish candle. The second is a large bullish candle that opens below the previous candle's low and closes above its midpoint. The piercing line pattern suggests a potential reversal from a downtrend to an up trade. So the pattern shows that buyers are beginning to step in as the second candle strong upward movement pierces more than halfway into the first candle's body, indicating a potential shift. So I'm going to show you a little bit of a difference of engulfing and piercing. So this is an engulfing candle here. You can see the first candle is bearish and the second one engulfs the first candlestick. So in this one also it engulfs the first candlestick. So for piercing, it has to be more than half of the body. So here we have it. So here it is. So as you can see here, you have bearish candle, and also we have the second one. As you can see, the second one, it's more than half of the body of the first candle. So after it if you see these candlesticks in the market, and also you follow other indicators to confirm to you that the market is reversing, you just need to wait for confirmation, then enter the market for a rise market. So for piercing and bullish engulfing candle, you can just use them the same because they usually appear almost the same unless you know how to identify them. So always be keen on that, but they work the same. So guys, I think that's the end of our video today, and I hope you have learned about the 5 candlesticks of trading the rise market. So for me, I'm going to concentrate on these 5 candlesticks, and that's what I usually use in my market, but I'm going to be sharing a few secrets here and there so that you can learn more about candlesticks. So guys, thank you for watching, and see you in my next video. My next video, it's about the bearish candlesticks that I use to trade fall market. Bye.